Hello and welcome to our webinar, Third-Party Risk Intelligence, delivering 360-degree situational awareness to the extended enterprise. And over to you, Atul.
Thank you, Sarah. Hi, everyone. 8 out of 10 enterprises reported a business disruption that was caused by their third parties. And this was in 2019, pre-COVID. And when you look at the supply chain disruptions we are seeing across the world, across the enterprises, across geographies, we very clearly realize that the whole definition of an extended enterprise has changed very dramatically. It's no longer just suppliers or partners. It is also brokers, agents, intermediaries, and so much more. So how does an enterprise ensure that they have total situational awareness so they understand the risk that they are facing so that they can actually prevent those disruptions and ensure resilience? I'm delighted today to have two experts on this panel with me today. Please welcome first Deborah Zoppi. Deborah has over 30 years of experience in the financial services industry, focused on resiliency and risk management. Deborah heads Guardian's third-party risk management program and remains a very active contributor in the industry to raise awareness and drive the evolution of third-party risk. Her focus very clearly has been to increase the risk management posture and ensure compliance with regulations without impacting profitability. I've known Deborah. Deborah is a strategic thinker that delivers results. Deborah, welcome to the panel.
Thank you so much, Atul.
I'm also delighted to have the father of GRC, Michael Rasmussen. For many of you that you know him, you know that Michael used to be at Forrester, where he coined the term GRC, and today is a leading voice and analyst, and his firm is really educating both the enterprises that offer these solutions and the enterprises that leverage these solutions, and making sure that he is bringing expertise not just around these solutions, but also where is the market, where is the need and solutions headed. Michael, welcome to the panel.
It's a pleasure to be here.
Wonderful. So without further ado, let's get started. But again, to the audience, please use the chat feature. Please use the Q&A feature to ask any comments. And of course, feel free to make, ask questions or make comments. So let's talk about the extended enterprise. Very clearly, when I'm talking to customers, they talk to me about how they're looking to expand the third-party programs. But the reality is, it's not just about expanding the third parties you cover. The whole universe of third party has expanded. So Michael, begin with you. What do you mean when you talk about the extended enterprise?
The extended enterprise is the modern organization. Today's modern organization is not defined by brick and mortar walls or traditional employees. Today's modern organization is the extended third-party relationships. As you've already stated, you have the suppliers and vendors and outsourcers and service providers and contractors and consultants and temporary workers and brokers and agents and dealers, intermediaries, and more. We can go on and on. That's the extended enterprise. You cannot define where the organization starts and stops. It's not black and white. It's not Boolean. It's shades of gray, really, because it's nested in deep supply chains and subcontracting relationships. And the issues in your third-party relationships are your issues. Their challenges are your challenges. Their compliance problems are your compliance problems. Their risks are your risks. John Donne, the English poet, said, "No man is an island entire of himself. Every man is a part of the continent, a part of the main." You replace that word man with organization today, and it applies so well that every organization is a part of the continent, a part of the main. And no organization is an island entire of itself. It is an interconnected risk environment. It's an interconnected business environment, and that's the extended enterprise. And these relationships are often complex because that part of your business that is in the extended enterprise, that supplier, vendor, outsourcer might also be servicing your competitors. Or your partners and so many other things. It's a very challenging time. And one of the biggest challenges organizations face is trying to manage risk and compliance and integrity like ESG in the context of the extended enterprise.
Absolutely. And Deborah, I think it'll be good because I know from the insurance world, that complex web can be very different than what other companies see. So Deborah, when you think about the extended enterprise, share some examples of what does that look for you?
So the NYDFS regulation, the cybersecurity regulation from 2017, not only did it expand upon the need to include law firms and brokers and third-party administrators into that view of what is a third party, but it also expanded the definition of the data that's being shared. There was previously, an expectation that it was only privacy data. It was about the person. Well, that also expanded to be non-public data. So that's now about the company. Well, we share data with a lot of companies for different purposes, whether it's marketing, whether it is for sales purposes, or just information that we're providing out to our customer base. So that third party, both the expansion of the scope as well as where the data is going to and what type of data is going to really broaden that span. In addition to that, we also had SolarWinds. SolarWinds completely changed what are we looking at, because we're not necessarily just looking at the third parties. We're also now looking at some of that key software that our vendors are using or their third parties are using that could have an ultimate impact on us because of the uptick in the cyber threat environment.
Right. So I think this is a good reminder to everybody, right? As you think about your risk management program, think about your definition of who you're monitoring, not simply as your third parties, but what does that extended enterprise that impacts your business as such. Let me move to the next one, because I know this is a question that I get all the time as the CEO of Supply Wisdom. Very clearly, risk is dynamic, and often the risk management and the risk assessment models that have existed have not been as dynamic. So let's talk a little bit about, what have you found to be inadequate or limiting about systems, risk management programs that you were looking at, let's say, a few months ago, a few years ago, that so many of us are trying to solve right now. Maybe we'll start with you, Deborah.
One of the big challenges that we have is, so the third-party supply chain is growing exponentially year over year. Our vendors are using more vendors. We're using more vendors. We've got new and emerging technologies that's out there, AI, that demand. We have the customer demand as well, that are looking for real-time solutions, that they can manipulate their own data within that. They want that self-serve kind of capability. So that's putting a real strain on how much you have to do. That poses the subsequent challenge of you have to periodically recertify those controls. So again, now the population is just growing too fast. And since you're not typically expanding your resourcing to accommodate, a larger population of assessment activity, you now have the challenge with how do I do it, but not take up as much time and space. So you have to be able to focus in on what are the key areas, try to scope this specific to the type of product or service that's being provided. And you absolutely have to be able to leverage some continuous monitoring tools to understand financial health, cyber health, reputational issues. And that plays into, from an ESG, from, all of those perspectives that are now in scope of what are we really looking at? It's not just those risk management controls on technology, it's the risk management mindset of the companies that we're working with.
That's a great way to say it. Not just controls, but mindset. Michael?
So, I mean, the physicist Friedrich Capra stated, the more we study the major problems of our time, the more we come to realize that they are interconnected and interdependent. They're systemic problems. And he was talking about biological ecosystems at that point, but he might as well have been talking about the ecosystem of the extended enterprise. That today's risks in the extended enterprise are interconnected. And so the biggest thing I've seen in the last, a year to 18 months, a shift and change is moving from siloed approaches to bringing together what I would call a federated third-party GRC strategy. And I call it third-party GRC instead of risk. Because at the end of the day, it's about the governance of those relationships. It's not just about the risk, but it's also, are those relationships achieving the objectives that we've even established that relationship, the purpose we established that relationship for in the beginning, the reliable achievement of objectives in each relationship. So it's a governance function, not just a risk function. But in that context, I'm seeing organization after organization I'm talking to that says we cannot have silos of risk oversight. And the analogy that I hear time and time again is, let's use a simple stoplight diagram of risk: red, yellow, green. Red being high, yellow being medium, green being low risk. What if IT security scores that relationship as a yellow? And then corporate compliance and ethics, looking at bribery and corruption, scores it as a yellow. And operational resiliency and continuity scores it as a yellow. And somebody else dealing with some other area of risk scores it as yellow. Do we actually have enough yellows that the aggregate risk exposure is actually a red? And when organizations are managing aspects of third-party risk within little silos, they're not seeing the full aggregate of risk in any given relationship. And it might be much more than the organization is even aware of. So I'm seeing a lot of organizations reposition a strategy that's looking at third-party risk or third-party GRC, which I prefer to call it, that crosses departments, a federated program that can be led by procurement or risk management, but involves a lot of other departments reporting into it and working with it as well, so that we can have more what I would call 360-degree situational awareness and intelligence of risk in these different relationships.
Deborah, Michael, thank you for that. Just to summarize, when you look at assessments, point in time are not enough. You need to continuous. You need to look at full spectrum of risk, as you talked about. And then finally, Michael, as you talked about, is that you've got to be able to have an integrated view. Otherwise, you actually miss out many of these. Before I go on to the next question, I thought let's do a poll. So I'm going to actually bring up a poll for the audience, and panelists, feel free to respond also. So the first question really is, who do you monitor for risks today? And I'm talking about monitoring. I'm not talking about assessing necessarily, right? Which is, do you monitor only your critical third parties? Do you monitor suppliers? Do you monitor all third parties? Or do you also monitor nth? And multiple choices apply. So let me make the poll live. So I'm going to let the poll be live for about 20 seconds. So really urge all of you to please respond. Who are you monitoring today? Only critical third parties, or all suppliers, all third parties, and also nth parties? Multiple choices are okay. I'm going to shut the poll in about 10 seconds. We have quite a few more that could be responding. So if you can, I would appreciate it. Let me end the poll at this point in time, and I'm going to publish the results. So I love, Michael, when you look at these, that only 57% are monitoring critical third parties, right? So there is a group out there that is 43% are even today not monitoring critical third parties. What would you say to that, Michael?
Well, I mean, I think what we need to understand is often what we call the butterfly effect. How do we define a critical third party? I mean, the butterfly effect is part of chaos theory, where the flutter of the butterfly's wings in the Netherlands makes tiny atmospheric changes that can influence the development path of a hurricane in the Gulf of Mexico. And so a lot of times those little things matter. I mean, you look at the Target breach. from several years back, like 2014, I think it was. That was a HVAC vendor, heating and air conditioning vendor that had a connection to the Target network for environmental monitoring. I mean, you've had that breach in the United Kingdom in which the casino, I think it was a video camera in a fish tank or something like that, was compromised. I mean, you look around me with the Internet of Things, my TV's connected to the internet, my speaker's connected to the internet, my blender in my kitchen's connected to the internet. If any of these have some type of backdoor Trojan installed, it can expose my home office network. And I'm working from home, but your third parties are working from home as well in the hybrid environment. And so little things matter. And so when people are only monitoring the critical third parties, what does that mean? How do you define critical? Because it could be somebody that might not be seen as a critical third party that can cause a lot of significant exposure.
Yeah, no, absolutely. And, Deborah, if you notice, only 52% said they're monitoring their suppliers. And some of this, I think, has to do with how risk programs are maturing. What advice would you have, Deborah, for those that, 40-some% that are not actually monitoring their suppliers?
I personally think that this is, it's something that's it's a growing area. I think many people, a lot of the industry forums that I've been involved in, people are still just getting into the criticality of their third parties, let alone getting into those suppliers. So I think it's something that we're going to see an uptick in as, as this year continues on, as we get into next year. It's a maturity aspect from my perspective. I also think that there needs to be greater integration between some of the tools that do that monitoring with the GRC platforms and make sure that you've got all of that data in one spot. It's just too difficult to maintain, multiple, I'm going to log into 6 different locations to monitor my third party. It's got to aggregate somewhere.
Right. And Michael and Deborah, I think that brings us to a good point, which is, hey, if you are going to move towards greater continuous monitoring, you need good integration between that and your GRC workflow platform. Michael, what are you seeing in that marketplace? Are you seeing that come together?
I'm starting to see the initial stages of that coming together, that people are integrating, and it could be a GRC platform that has a third-party module, or it could be more of a dedicated solution, because we have the broad platforms out there for GRC that have third-party modules, but then you've got dedicated platforms that just do third-party GRC, the workflow tasks and that type of things, like the Aravos and Coupas and others out there as well. But these solutions need to be augmented with strong third-party risk intelligence. And historically, that means going to a lot of disparate different databases, and connecting to a variety of feeds for politically exposed persons, watch lists, sanction lists, negative news, security ratings, financial ratings. I can go on and on and on. And nobody really brought it all together, because in the past you had to connect to all these different feeds to get this information. Now we're starting to see third-party risk intelligence providers like Supply Wisdom that are aggregating and bringing all this information together through one source, which makes it much easier to manage.
Michael, absolutely. So Michael, I think this is a perfect time to maybe talk about and go a little bit deeper into, often when I'm talking to customers and companies and I talk about continuous monitoring, often the feedback I get from them is they actually think they are continuous today. And then when you dig deeper, what you find is that they may be continuous in cyber, right? But when you start looking at the other risk domains, they are thinking of continuous as they're doing it once a year or they're doing it once a quarter. Deborah, does that resonate with you in terms of how people may have ill-defined continuous and not clearly defined what does full spectrum mean?
Oh, absolutely. But it's also, you can't boil the ocean. So there is a very fine balance that has to be maintained, because if you're continuously monitoring every one of your vendors, now you need the resources to look at all of that. So you need to smartly design what you're alerting for, what's the trigger. You need to understand what's in the news, what does that really mean? The financial health of the company, that cyber health, as you've mentioned, getting all of this connectivity across those systems is really important so that you have that full view of how is this vendor doing? Are they in trouble? Because one number does not necessarily equate to they're going out of business. Sometimes the cyber scores, just by the nature of the type of company, sometimes that cyber score is not a great indicator for how well a company is doing because it's at too high a level. You've got those companies that have, subsidiary activities that are going on, and you really need to see that breakdown. I don't want to see JP Morgan Chase. I want to see a particular line of business for them. And that's really important to have. And that, it kind of all triggers in to pull all of it together. I think that it's just really important to understand that full picture of a vendor.
Michael, look to your view as you were talking about 360-degree situational awareness. Talk to us a little bit more in depth around how you think about maybe these risk domains or key criteria under that one ought to think about moving to more of a continuous model than just a pure point-in-time assessment.
Yeah, well, I mean, first off, what I find interesting that jumps out at me is you have ESG in the middle, but ESG sort of covers every one of these areas because ESG is sort of all encompassing because it includes the financial aspects, the cyber operations, compliance, and more. And if you look at like the Germany Corporations Due Diligence Act, it gets down to nth parties. There's so much happening there. But I'm sorry, I just was commenting on the slide. What was the specific question now that I went on a rabbit trail?
No, Michael, that's the perfect example of complexity of risk management in GRC. What I wanted, Michael, you to comment on is talk to us about, often when I'm talking to a customer and I find that they do financial due diligence and cyber due diligence, and a lot of times the other domains are ignored. So talk to us about this movement to 360 situational awareness and why it's maybe important to look at all these 7 risk domains and kind of go deeper into what's under it.
Yeah, well, one of the aspects that you were just referencing is the idea of continuous assessment, and I think that's extremely important because business is dynamic. It's changing minute by minute and second by second. Not just your business, but your third parties, your extended enterprise. Their business is changing. They might have been the right business to do organization to do business with 3 years ago, but are they today? Has their cyber position changed? Has their financial position changed? Has their bribery and corruption position changed? Has their commitment to the environment or social aspects, modern slavery changed? And we have to keep up on this. And today, with continuous risk intelligence, you have similar to what we have for credit monitoring. I subscribe to a credit monitoring service, and if my credit score changes or there's some type of check on my credit, I get alerted right away. I know about it that day, and that's important. It's actually saved me and my wife. It was about 18 months ago. All of a sudden, I get an alert that there's some type of negative report on our credit. And it's like, what's this? I don't know. We should have a negative report. And I would go and I look into it and found out that, my wife had a medical procedure and they had an address that they billed, even though she filled out the form correctly, they had an address that they billed it to that was from where we lived 30 years ago. And actually, it was the house she grew up in. And it wasn't her current address. I mean, she hadn't lived there for over 30 years, and they sent the bill there, and so we got that corrected, by the way. But that saved us in that credit by alerting us to a change. The same thing with businesses today in the extended enterprise. What you have for any personal level and continuous credit monitoring, you have continuous risk intelligence in your third party. So if there's a change in some type of negative news or politically exposed persons or cyber or whatever it might be, you can be alerted to it that day instead of 6 months down the road, 9 months down the road when you have some type of periodic due diligence assessment. Continuous risk intelligence can save our firm money, but also save us from significant risk exposure and events by alerting us early to those.
Right. And so I think just to reaffirm here, it's important in today's business environment to no longer just monitor for financial And cyber risk is really to look at the entire full spectrum so that you have an early warning of disruptions, because often what we are finding as we do a lot more look backs into incidents is a cyber incident doesn't start at cyber. It starts with potentially maybe employee issues, attrition, financial issues, lack of operation controls. So often what we can find is that if you had early warning on the other risk domains, you prevent disruptions in another risk domain for that matter. Michael, Deborah, I'll be happy to add to an answer on this, but there's a question, but I'd like you to take a shot at first. So the question is, when you move to continuous monitoring, the noise rises, right? So at least people have seen the programs of the past that provide negative news monitoring service. There's a lot of false positives. What have you seen, and how do you deal with it?
I'll start by saying I think this is more of an art than a science. I think that depending on the number of entities that you're monitoring, there absolutely can be a whole lot of noise. I don't know how practical this is, something that we've actually struggled with ourselves, that having a single person doing a review of all of those alerts coming in to decide what's relevant and what's not can be a challenge. Some of what we may need to do is, as we grow more into this space, is really start sharing the information that's being brought to our attention with the business, so that they can then make that determination as to how relevant it is to the particular engagement or type of product or service that the vendor's providing for them. I think this is a great opportunity to raise that awareness and get other people more engaged in the process, to start thinking from that broader perspective, that it's not just about they're meeting their SLAs. It might be about other things that are going on throughout those companies.
Michael, do you want to add anything to that?
No, I would agree. I think as we leverage artificial intelligence and things like that, it can help fine tune and help us get rid of some of the noise out there, but some of that is still maturing. But it's better to be alerted and have to go through a little bit of noise and things out there than to remain ignorant of something out there in the environment. So I would say that it's better to have some noise than no noise at all and get caught off guard by something you miss.
Yeah, no, definitely. So I think just for the audience, I'll share our experience at Supply Wisdom. In the end of 2019, our machine learning algorithms that were doing alerts were about 65% accurate. By the end of 2020, we had reached 87% accuracy. And today that accuracy is over 90%, right? So I think there's been tremendous development in automation and data science to enable greater accuracy. And then the other thing we find is that as customers provide to the system not just the name of the third party they want to monitor, but as they start providing details like what service, what location, that the accuracy actually rises even more so, because the accuracy is about relevancy. The other thing we've been able to do, what we have found in machine learning, is you can actually do impact analysis. So it's not just about which risk domain is impacted by this news item or this information that's coming in, but what is the impact on the organization? And if you have the size of the engagement, the kind of the engagement, and also location, you actually get to a much higher level of accuracy, and it's going to keep rising. So this is a perfect time to do another poll, and then I'm going to jump into ESG after this. Michael, I know this is a topic you've been speaking quite a bit about, and Deborah, I know you've been looking into it. So the question is about continuous monitoring, and please, to the audience, as I bring the poll, I want you to think about not once a month, not once a quarter, not once a year, which one of these areas or risk domains are you continuously monitoring today? So it's all the time. And let me bring up that poll. So I'd like you to answer, and again, multiple choices apply. So which of these risk domains are you continuously monitoring today?
Unfortunately, I think there's another answer that's not on there is none of the above, because I think there's so many organizations that still aren't doing what they should be doing in this area.
It's a good point. Good point, Michael. It's a miss on our part. So so again, are you truly monitoring the ESG status of your third parties on a continuous basis? Or is this something, if you're doing once a year assessment, that's not continuous? So as you answer, think about kind of in your organization, which one of these domains is done continuously and which ones are done, are not for that matter. I'm going to let it open for another 30 seconds, and then I'm going to end the poll and show the results. We have only less than half the audience participating on this one compared to the last question. So I have to believe, Michael, that the answer might have been none of the above.
Yeah.
For about half, because about half of them have not responded. So let me end the poll in 5 seconds. And so we'll have to keep in mind that about half the audience did not respond, which I'm assuming their answer is none of the above. When you look at this and you notice that, locations, operations, ESG have some of the lowest level of continuous monitoring, what's your reaction to any of this data? Do you see them? You see this as challenging? You see this moving in the right direction?
I think that it's just a matter of maturity and adjusting to the world. I mean, ESG is something that's new for a lot of organizations. Not completely new, because before we had corporate social responsibility, CSR. But the issue there was that CSR was passed around the organization like a hot potato and often landed in the lap of marketing and became a branding exercise. ESG, on the other hand, has teeth. Boards of directors are being voted in and out based on ESG metrics. BlackRock, State Street, and other institutional corporate investors are making investment decisions based on ESG practices. Customers are making decisions on who they do business with, on the values of the organization. Even employees, particularly the millennial generation and Gen Z, they're making employment decisions not just on salary and benefits, but on the values of the organization. ESG is critical, and it's got teeth and it's got regulatory enforcement. And so I think it's just a matter of time and maturity, because there's been a lot of focus on the cyber element, which cyber is part of the G in ESG, but ESG is so much broader than that. I think that it's just a matter of time as organizations start to build their ESG practices, particularly in the extended enterprise and responding to the EU directive and the Germany Corporation Due Diligence Act and things like that. The ESG aspect starts to become more and more prominent in their continuous monitoring risk intelligence needs.
Right. So one of the audience members just shared a comment that I want to share with everyone. Right. So the approach that they took, and this is a bank in Ireland as an example, that the areas that they monitored continuously were tiered. So the most highest tier, the critical tier, and that's where they started as they look to their journey to mature their programs. Thank you for that, Charles. That's really good feedback. One question from the audience that, Michael and Deborah, if you have examples, would be great to share, and I'm happy to add to that. They're asking, do you have examples where, because of early warning of a disruption due to continuous monitoring, it helped avoid a disruption and can basically avoid that risk? Do you have examples you could share? Let me jump with an example, because I think it'll prompt. So there is a tremendous amount of examples that exist from a location disruption perspective. Announcement of a typhoon that's 5 days away, or potential floods, or elections, or the death of a celebrity that may actually, because in many locations around the world, those kind of incidents cause an issue where employees cannot go to work at their offices. Now, again, COVID created a different situation. And so many times these customers, because of this advance warning, issued laptops and soft security tokens, VPN access to their employees so they could work from home. And that's right, they avoided that disruption. I have another cyber example, but I wanted to see, Michael, Deborah, if you have any examples you wanted to jump in with.
Yeah, we had similar examples to what you had spoken of, where there were city shutdowns or there were water shortages. And I don't know that they necessarily resulted in any operational impact, but it did trigger us to invoke our business continuity plans. So, you know, we did have our people either redirected to other locations, or we did leverage, you know, work from home strategies, you know, outside of the pandemic, obviously. So we did have those examples. We've also had ones that, again, did not necessarily impact the delivery of the product or service, but stimulated conversations between our business relationship owners and the vendors to understand what was going on and what were they doing about it. There were, you know, purchases of one company by another. What does that mean? Is it going to result in an impact to SLAs? Even during the pandemic, you know, when we were hearing about the furloughs that were happening, that gave us the ability to take action proactively and make sure that we were in communication with those vendors that were doing those furloughs to understand if there would be an impact on the availability of resources to service our need. So again, I don't know that it necessarily resulted in a direct impact, but certainly provided that greater communication, the planning, the proactive response.
The most obvious examples that we saw was, Michael, did you want to jump in before I?
Well, I was going to say, I mean, I think the resiliency and continuity aspects of the supply chain, navigating geopolitical risk and supply chain shortages and things like that, are the easiest to cite. But on the flip side, there is, you know, lots of interactions I've had with companies that were politically exposed persons related to bribery and corruption, or alerts around modern slavery because maybe, you know, a factory is restaffed and things because of the pandemic or something else, and all of a sudden there's child labor and forced labor that's on the rise in a certain country because of conditions. I've seen that save some organizations. Nothing that I've been blessed where I can like publicly talk about specific companies there, but I've seen those examples.
Yeah, and Michael and Deborah, I was just thinking about, you know, Supply Wisdom released its first alert on Wuhan viral pneumonia on January 2nd, which ended up, you know, later named COVID-19 as an example. If you go back to March, April, you can see a list of companies in global locations that were resilient, that had the ability and responded very quickly to work from home, had no disruptions. And there's a long list of companies that did not. Companies that heeded early warnings and acted. At the end of the day, early warnings mean nothing if companies don't act. Right?
In fact, it could be a liability to them too. I mean, if you get alerted and you fail to act, you know, that's having knowledge and you didn't do something about it.
Right. At the same time, Michael, regulators are no longer sympathetic to companies saying that I don't have a warning system. Right? It's just you have to have
I
good
completely
management
agree with
practices.
you. Yeah. I mean, the regulators are cracking down in this area. I mean, ignorance is no excuse anymore.
Right. Ignorance is not an excuse. Very much so. So I think those are some great examples of where early warning can really help you avoid disruptions. Right now, when you look at supply chains, if you are monitoring not just your suppliers, but the nth parties where things are originating from, and you were monitoring how markets were opening and closing, when ports were open, when they were closed because of COVID, you actually have an early warning of a potential disruption that's coming to you because of restriction of supply at the source. But companies that are not monitoring that are not able to understand that. Now, there's an area that I want to jump in a little bit deeper because we know it's getting tremendous amount of attention, of course, in the US on Wall Street, but also massive attention in Europe. And Michael, I know you were recently, you did a trip through Europe as you were talking to companies, which is ESG. Let's talk about, Michael and Deborah, how is ESG redefining TPRM and particularly supply chain risk? And again, Michael, I agree with you. the ESG is much broader. And, as you know, we do 7 risk domains, but this particularly how we focus the ESG category as an example. But how is that impacting TPRM? Deborah, maybe you or Michael can start first.
Sure. We're in the beginning stages of incorporating the ESG elements into our program more formally. I'm going to speak to more about the challenge of integrating this that we've encountered, which is I now collect this information about what a third party is or is not doing. What do you do about it, and how do you, because this results in a larger change to who do we go into business with if they're not doing the right things. They're flying their executive team on Lear jets around the world for a holiday party. Okay, what do I do with that information? Does that result in we say no, you can't go to contract with them? If they're not, what do you do in the instances where you already have that contract in place and you realize that there's a lot of bias in, who they're hiring, how they're giving advancement opportunities, those types of issues. Again, what do you do about, you've got those existing. So while we're beginning stages of implementing what we're doing as far as assessing what our third parties are doing, on the flip side of it, we have to also define what do we do with it once we know the answer. So
Right.
we're not as deep and mature into that space right now, but we're doing an awful lot of research and exploration so that we have a really strong handle on this, because once we know it, we have to have action. We have to know what we're going to do about those elements. So we're looking forward to the continued evolution of getting this better incorporated into the program overall. But we're at the beginning stages and
Right.
trying to really expand our mindset and our understanding of what those impacts are and how do we want to address it at a company level.
Right, Deborah, many companies doing that. Michael, what advice are you giving to companies regarding ESG and risk in GRC?
The advice, start working on it now. I mean, because this is serious stuff, and it's got a lot of attention from the board on down, from the regulators as well. And so organizations have to be paying attention to this. And so in that context, we need to address, what we're doing to address ESG within the organizations, and be able to properly manage this across the extended enterprise. But it's very complex. We were just talking about this, you and I, before the webinar this morning. In the last several weeks, I'm having daily conversations several times a day on ESG. But what's interesting is the governance, the G in ESG, there's a lot of commonality across different industries. And so when you get into things such as shareholder rights and bribery and corruption, information security, internal controls over financial reporting, board structure, things like that, that's very common. About 80% of the G in ESG is common across industries. But the E and the S, there's a lot of variation. And an environmental program at a pharmaceutical company or a petroleum company looks different than it does at a bank. And so there's a lot of variation when it comes to the E and the S by industry. I sat for a period of time on one Fortune 100 company's Social Accountability Advisory Board, all focused on the S around international labor standards of child labor, forced labor, working hours, wage and hour, health and safety of a global supply chain of 20,000 facilities, and how they go about measuring risk at each facility level around the social aspect. But that's just the social. They didn't really, within the same program, look at the environmental in the G, and now they've got to bring all this together across these different areas, because ESG reporting requires some type of integration across these different domains in your supply chain.
Yeah, this is a really interesting area, because on one end, in certain industries, the regulators are starting to ask for disclosure. And we know before, once you start disclosing, there might then in the future, they become requirements. But the most important aspect of this is when we look at data around how consumers are making decisions, and particularly how talent is making decisions on who they want to work for, good ESG practices pay off in that area. And so I think we are barely seeing the impact of ESG to enterprises, but very soon enterprises will realize the impact of talent. And of course, eventually that translates into reputation and impact on revenues. So we've talked about kind of the challenges with existing programs. We've talked about the importance of continuous monitoring. We've talked about why one needs full spectrum coverage in terms of looking at all these risks. And the question that keeps coming back from a lot of people is, well, help me understand or give me some ideas around how should I enable this move to continuous risk management? So much more of a practical, right? Because as we saw, there's about half the audience said, hey, I'm not covering any of these continuously. But they're highly aware that they need to move to a continuous model. So I just wanted to kind of maybe take us through 4 stages of how one moves to continuous monitoring. And Deborah and Michael, love for you to comment on in terms of what you're doing or what you're seeing truly in the marketplace in terms of kind of leading adoption of how one moves towards continuous monitoring. So maybe first start with, continuous monitoring starts with understanding what your scope and world of third parties is, and understanding how you have tiered them from most critical to maybe low transactional type, and accessing a system of intelligence that is truly continuous in nature. So I think that becomes like the first requirement, that you access a risk intelligence solution that is full spectrum and truly continuous in nature. And then be able to bring that into a workflow software. Michael, you've been in GRC for a long period of time. You get it. You've known this for 20 years or more. When you think about intelligence, let's maybe go back to assessment first. First, assessments into workflow. And now we're talking about continuous intelligence in workflow. Any thoughts on what would be a good way to do this, a leading way of doing this?
I mean, to me, I've got, a several step program in addressing this. And the very first step is understanding your current state and then defining your future state. And most organizations are doing something today for third-party risk. And a lot of times it can be manual processes, so it's very ad hoc and broken and reactive. It could be that they're doing things in different siloed tools. And maybe it's a combination where one department's more of a manual process, where another one's using some type of workflow tool, module in a GRC platform, and some other departments using something else. And then you have organizations that have sort of brought things together. Maybe they have a common platform for third-party risk, but then they haven't really addressed the intelligence, the content piece of it for continuous risk intelligence in the third-party relationships. But so to me, the first stage is understanding where you're at in your maturity of third-party governance, risk and compliance, third-party risk management. And then where do you want to be within 2 years? And what's the roadmap to get there and the steps you need to take? And that step might be retooling your third-party GRC platform, that you need a consistent platform, and then you need to integrate a third-party risk intelligence solution with that platform. It might be that you already have one of those, and you need to move to continuous risk management by integrating that third-party risk intelligence solution into what you already have. But you need to have a clear understanding of what you're doing today, what you're trying to achieve tomorrow, and how you're going to get there. And part of that vision should be how you're going to address continuous risk intelligence.
Right. Deborah, did you want to add to that?
I'm not sure there's much more to add. We've actually just done exactly that, and we've looked at our full workflow. We've identified the number of tools that are being used. We've used certain tools independent of other ones. And again, it's back to that maturity that we're now looking to better integrate the data across the various tools, gain some alignment, and do a better job at sharing the data that we're getting. There's other teams that have other purposes for the same type of data. So rather than going and getting yet another tool that's happening in another silo, really being able to share that the knowledge that we're getting with the other stakeholders that have a need for the same type of information.
Thank you. So just for the audience, just to kind of repeat certain takeaways for you is pick a continuous risk intelligence solution, because that's critical to making sure you have early warning. Look at your workflow software and think about how to integrate those two, because eventually your risk mitigation, risk management is going to be managed in your workflow software. And in this world of open APIs, it is actually fairly easy to actually integrate those. And then on the final end is think about your standard operating procedures around what does risk mitigation look like. So when you receive an incident, when you receive an alert, when you receive a change in intelligence, what does that mean? And so one of the concepts that I've been talking about in this industry is this, whether it's virtual, whether it's staffed, whether
and whether it's a combination of people and tools, what you really are doing is integrating this process from risk intelligence to risk management to risk actions, and potentially you're going to be able to automate a lot of this. So Deborah and Michael, for our final question, so think about kind of takeaway for our audience that very clearly is very interested in 360-degree situational awareness and kind of this move to continuous monitoring. What advice would you have based on what you have done, what you have seen? How do they sustain and maximize value from continuous monitoring? And also, as you think about what could they keep doing so they're continuing to mature in these third-party risk management in their GRC journey. Deborah, let me start with you, and then Michael, you can close us off.
I'll focus on two pieces. I think first and foremost, the awareness has to be raised with the people that own the relationships with third parties. They need to understand the various types of risks that need to be taken into account as they enter into these contracts or expand contracts to do new and bigger things with existing vendors. On the second part of that, when you're picking the tools that you're going to use, there's a lot of tools out there. Some of them have very limited insight. Others have a much broader set of offerings. You want to make sure that you're getting the right tool for what you're looking to accomplish. And then make sure that that tool can, in fact, integrate with the tools you may be using, your GRC tool, your third-party risk tool, if it's something happening independent. And make sure that you're connected with the other risk teams that are involved in the end-to-end process. Your procurement teams, your legal teams, your IT experts. You want to make sure that they're part of that solutioning and they're aware of what you have to offer, because your information can really be reutilized in a lot of these other work streams and really benefit the overall end-to-end third-party risk management activity.
Deborah, thank you for the reminder that this is not just about intelligence and tools and technologies. It is very much about the whole stakeholder engagement. Michael, to you to wrap it up.
Certainly. When I look at helping companies build a business case in this area to move forward with services and content or technology, I build it around the three angles of efficiency, effectiveness, and agility. How is a continuous risk management solution intelligence service going to make me more efficient? Time saved, money saved, like moving down from 200 employee hours to monitor something down to, less than 5 minutes, time saved, money saved. But also, how is it going to provide value in being more accurate, complete, thorough, less things slipping through cracks, being caught off guard? There's value to measure there. But the third angle is also to being to keep up with change, regulatory change, risk change in the external world, like geopolitical risks and things, disruptions, but also changes in the business environment itself, not just in our business environment, but in our third parties. And how is this third-party risk intelligence solution not only going to make me more efficient and effective, but how is it going to make me more agile and resilient to developments around the world?
Michael and Deborah, thank you so much for sharing your knowledge and helping us advance GRC and TPRM. To the audience, this taping will be available on CRO Wisdom, crowwisdom.com. And also, if you have any questions or comments on this webinar, or if you want any additional information on continuous risk intelligence and how to move to a continuous third-party risk management program, please don't hesitate to reach out to us. And Michael and Deborah, once again, thank you so much for being with us.
Thanks for having us.
Thank you.